Yeah, I'm losing my
The
edge.
equity index pairs.
Three levels of equity pairs, Pete. This has been the trend here in 2021, for the most part of 2021, is equities not seeming to go anywhere. With that being said, they continue to trade places for outperformer, underperformer. So I wanted to dive into equity pairs, look at three different types of them, look at what we think is the best opportunity for trading equity pairs, and hopefully leave people off with some ideas for their own that they can go into their portfolio and trade page and practice themselves. Pete, pairs are neutral trades that take offsetting positions in two similar markets. Now, here is an example: two equity markets from the small exchange. You got the small stocks, you got the small tech, two futures markets that cost you about $500 to trade. Very nice, clean, small, standard, simple, efficient equity markets. But Pete, they hold two different baskets of stock. And so if I bought SM75 and I sold sticks, I'm primarily buying, Tesla, FCX, CRWD, the top three names in there by weighting, and a handful of other stocks. And I'm selling mRNA, Zillow, Z there, and Snapchat, and a handful of other stocks. And no longer now do I care if stocks in general go higher or lower. I just want column A to outperform column B. What say you?
I couldn't agree more. And, we see this market that has, in the equities world, that has had these huge rallies. And, so you're trading one side of that. And we all at some point had a bearish bias. And I think you and I have had bearish biases way too early at some points, and we continue to have them. But the thing that I think has kept us in the game, in a market that's moved so quickly to the upside, it's very difficult. I've said this before, but we're not momentum traders. We don't buy new highs. So what is left of the toolbox? Well, any number of short strategies, whether it be with static or dynamic deltas. How do we diversify within an asset class that is moving truly in one direction? Except, we see these brief pullbacks. They don't last long. They're difficult to manage. So these pairs trades become an important part of diversification. And for me, and this is the one thing that I think really resonates, is when you look at this, buying either one of these, you think that, on a small scale, have we seen a pullback in SM75? Yes. But we're still buying the upper 5th% of the move over the last couple of years. Here is a thing where you can buy that upper 5th%, as long as you're pairing it with something that has a relative value interest to it. You don't care about that, where you're buying that outright in relationship to where it is. You're trading the relationship between the two underlyings, which I think is the key takeaway here.
Yeah. No, yeah, key term right there, relative value. Because in so many things in life, you don't have the ability to buy something and sell something else against it. Housing, for instance, a lot of people talking about moving to places like, Florida or no, but seriously, like Florida or Colorado and everything like that, as they move out of urban environments. You don't have the ability, though, to necessarily buy a house down in Florida and sell a condo in New York City, do you? Like that's, to me, such an interesting trade, as opposed to what most people in financial markets think is, all I can do is buy. And that really hangs you up there because you only have, it handcuffs you into one side of the trade, where thankfully with these futures markets, so easy to pairs things together and trade that relative value. Because look at this, Pete, two equity markets here that are up since those lows of 2020 there, Pete. SM75 is up 100%.
Right.
Okay. The small tech index is up 100%. Who in their right mind would feel good about buying into that up move? And maybe you do. Maybe you are a trend follower. And hey, it's worked out so far,
right,
with a few bumps in the road there. But what you can feel really good about is, they're both up over 100%. In the last couple of weeks, though, SM75 put up over 10% on top of sticks relative value. In the last 2 days, it's come back 3 or 4%. That is a great opportunity. And I think this is probably the best example between equity indexes. That's where we usually live, right? That affords us some of the best opportunity, because there are some names in small stocks that are in small tech. In the same way, S&P against NASDAQ, similar scenario. This is probably the pairs trade that we employ most often when you relate it to something like a stock market and a single stock. Now, this can be interesting at times. We look at this every once in a while, especially an index like NASDAQ, Pete, that's so top heavy. You can feel kind of better about, I'm going to buy the NASDAQ and sell a call in Apple or Microsoft, or sell shares in that stock because it's like 15%. But you look at the top stock here in small stocks, this futures index here, and it's only about 3 or 4% because we don't want top heavy indices here at the small exchange. And look at the fact, compare the y-axes here, Pete. Would you feel comfortable pairing a stock market that, yes, is up 100% from those March lows, but would you pair that against a market that is quite literally up over 500% in the same time frame? This is one we don't go to very often, right?
No, we don't. And I think the interesting part here is when you do pick out a component, you can find another diversified set of trades. I think the crossover piece of this in terms of performance is really interesting too. I think you want correlation and you want tradable opportunity. Tradable opportunity just doesn't come from divergence. We've seen great reversion divergent trades because we know there's a greater statistic propensity to revert within a asset class, two pairs, than just the market in general reverting, especially something with an upside bias like equities. That's where we find the tradable opportunity. So I think this is just another way of creating that opportunity, that diversification within the asset class. Because I think the frustration is, well, whatever I pick, I don't know. We're seeing this lagger leader between Russell and NASDAQ. I don't know which day it's going to be, and we don't know which day it's going to be. It's very random, and it's very difficult to pick. Here, we're actually, I think we're getting closer to the tradable opportunity here between picking these two components. I like the way where you went with this because you're talking about, the lead constituent within the index and looking for the tradable opportunity around that index, irrelevant to where the index itself has been.
The key to a good equity pairs trade, Pete, is exactly what you just said, which is a good correlation and divergence. Because you can have a good correlation, for instance, right here I have the NASDAQ futures and the NASDAQ ETF, and you can barely even see that white line in the futures edging out below the ETF. There's no opportunity there for the everyday trader. There's no opportunity there on the retail side to pairs trade a future versus the ETF version of that thing. It's got the correlation piece you spoke to, but it doesn't have the divergence. And so this is where we get to, Pete, where you can pairs trade any stock market, you can pairs trade anything against another item at the end of the day. But you don't want to get two things that are too close, Pete. You don't want NASDAQ futures, NASDAQ ETF. There's nothing there for you. You don't want things that are too far, right? Like Tesla against Coca-Cola. That's absurd. Of course, you're going to get a huge divergence. There's no correlation there. Right. You want something that has a good correlation and divergences and convergences opportunity there, similar to small stocks versus small tech. That's the key there to the equity pairs.